In this track and trade trading training video, I want to talk to you just a little bit about the market probabilities indicator, which is part of the seasonals indicator. Now, the seasonals indicator is a data cube that goes back and actually concatenates as much history as Gecko Software or as Track and Trade has accumulated in its database. Most of that data is over 20 years back in history. And so we have about 20 years of history of most markets. And so the settings on this indicator give us the ability to come in and set us back to 20 years. And what we do then is we go back and analyze this data cube or the data in the particular commodity for 20 years. And then we find the largest portion of that probability statement within those 20 years. And you can see here we then state that at 14 years. So 14 is the furthest back that this is found anything that's relative to any change within the market. And so that's why we set this at 14. You'll see 14 here, even though the indicator is set at 20 years. Nothing has actually been consistent over the last 20 years, but we have had some consistencies over the last 14 years. And so that's why we reach out to the highest consistency level. Now, the highest consistency level meaning, of course, that we're looking for extremes in the market. So we're looking for an area where this market is reaching up into extremes or down into extremes. And so these are going to be basically turning points or areas in which we can anticipate a market having a turning point or an area where the market is going to close higher than the previous day or close lower than the previous day. And that's basically what this is telling you. And the one way that you can use this is by looking for the probabilities. Now, let's say that we come in here, and let's say since we're in Track and Trade, and this is a historical simulator, you'll notice that this thing shoots out into the future. Now, this will do this on the current markets as well as in the simulator. And as the market comes across, you can see, because this is a historical view of the data, we have this data from previous years. Therefore, we can shoot it out into the future, and you can look at and anticipate turning points or areas in which the market's going to have a tendency to do certain things. Now, it's not to say that the market's going to repeat itself every single year. It obviously does not. But it just says that over the last certain number of years, it's had a probability of doing so. It's had a high probability of making a reversal point here, or having a situation where the market is actually changing directions or has a high probability of being higher, closing higher than the previous day's close. And so we're going to be looking for opportunities for the market to reverse or have some type of a situation where we can take advantage of this information. So let's come in here and just do a quick trade simulation. We're going to come in here and we're going to go short the market, and we're going to sell one on a stop if this market continues to drop, since this is a sell signal coming off of the bulls and bears. And we're going to say, let's just go in with one contract. And we're going to step the market forward, and of course we're going to have a margin call. So let's come in here, say that we opened up our account back on May 1st with $5,000. And we're going to go OK. Now as that market moves forward, of course we need to move our stop in there, and where are we going to place our stop? And we're going to buy one on a stop if the market bounces back above the red price bars. So as this market continues to drop forward, now there's obviously a number of ways that we talk about and we teach how to follow and trail your stops using different areas of support and resistance or mathematically calculated stops. But one thing that we can watch for is we can watch for a reversal time frame based on the market probabilities. Now, here's a probability of a market having a tendency to rise in price, be higher than the previous days. And you see a couple of those in a row in an extreme. So this would tell us that right around this time frame, we should be looking for the market to maybe rebound or reversal. And if that's the case, what we want to do is use that information in our favor to say, okay, I'm coming up on a high probability of a reversal time frame here. Maybe I want to tighten my stop in. How close do I want to hold my stop? If this market reverses and turns around on this time frame or during this time frame, maybe I don't want to have my stop back so far simply because I'm risking more money. So I am risking at this point, roughly $681 per contract, and maybe because I've got a high probability area that this market's going to turn around and come back against me, and I've even got a rally kind of looking in here, then maybe what I want to do is tighten my stops up in here, and just in case that thing pops back up against me. So we got one more day, and just as it indicated in the probabilities indicator, we did have a reversal on this, and the market started to rally through this time frame. So we use that as information for us to actually tighten in our stops and take some profits and have a little bit of foresight into what the market might have a tendency to do. And that's just what the market probabilities was designed for.
The content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and training techniques by industry leaders. This should not be considered as a solicitation to buy, sell, or invest in securities, options, futures, or Forex. Remember, trading does involve the risk of loss. Past performance is not indicative of future results. Stocks, futures, options, and Forex trading is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.